This episode of the Lloyd's List podcast is brought to you by Lloyd's Register. Visit lr.org for more information.
Berlin is famous for many things. The wall that once separated East and West Germany, Marlene Dietrich, 3 classic albums from David Bowie, and 2 Bundesliga football teams in Hertha and Union. And last week, the German capital crowned those achievements when it played host to the International Union of Marine Insurance Conference, held in the city where its predecessor was launched 150 years ago. The good news for those 800 plus delegates assembled was that the marine insurance sector looks to be in great shape. IUMI isn't allowed to discuss rates as such, but the big reveal each year is an analysis of premium volumes, which hit almost $39 billion in 2023. That's up almost 6% year on year. Premiums for hull, cargo, offshore energy and marine liability were all up, with Asia and continental Europe in particular doing well, as Lloyd's of London continues to lose ground. That's good news for marine underwriters who have to fight the sector's corner at diversified insurance companies where marine is typically a single-digit percentage slice of the overall book. But it's in the nature of insurers to point out the worst that might happen, and the downside of this relative success is that marine is continuing to attract new capacity, which is helping to restrain premium levels. There are other topics of concern, of course. There was a lot of talk about the insurance implications of the Houthi campaign against shipping in the Red Sea, and clearly, the Baltimore Bridge collapse is going to be a biggie, and several sessions were devoted to the implications. But that one will run and run and run. In fact, a lawyer told those in the conference hall that he expected litigation to establish liability to last for anything up to 10 years. My name is Joshua Minchin. I'm a reporter here at Lloyd's List, but this week's episode comes courtesy of our law and insurance editor, David Osler, who assembled a star-studded panel of senior figures in the niche at IUMI to discuss some of these issues. Joining Dave on the podcast are Richard Sayer, Global Head of Marine at Allianz Commercial, Rob McAdams, Chief Underwriting Officer Marine at Munich Re, Astrid Zeltman, Statistician with Nordic Marine Insurance Trade Association C4, Jun Lin, Head of Portfolio and Business Development at Guard, and Paul Weston, Head of Hull Underwriting at Markle.
My name is Rich Soja. I'm the Global Head of Marine for Allianz. I am based in New York City.
Good morning, Rob McAdams. I'm the CUO for Marine Engineering and Special Risks at Munich Re. I'm actually part of the primary insurance division, Munich Re Specialty Global Markets, based in London. I've been there for 4 years.
My name is Astrid Zeltman. I'm the analyst of the Nordic Association of Marine Insurers, where my main task is to compile hull statistics about fleet and casualty trends. And then I have, on behalf of the Nordic insurers, I've been on the IUMI committee, on the IUMI Facts and Figures committee since 2004.
My name's Jun Lin. I head up business development for GAR.
Paul Weston. I'm head of Hull at Markel International.
One of the star turns at IUMI conference each year is the Facts and Figures presentation given by Astrid Zeltman, the in-house statistician at Nordic Marine Insurance Trade Association CEFOR. IUMI is not allowed to discuss pricing and therefore concentrates on premium volumes instead as some sort of indicator of the overall health of the various marine insurance segments. We're lucky enough to have Astrid with us. So, Astrid, can you take us through what you found for 2023?
Yes, of course, David, I can do that. With regard to the health check, I think the best health check is not only to look at the premiums, but to look at the results you get in marine insurance, because you not only get premium volumes, you also have to pay some claims from time to time. So you should really look at what you have left in your book after you have paid the claims. And of course, there are different drivers for the premiums and the claims. As you say, results look pretty nice now over the past 3 years or so. Now there has been a positive trend across all lines, more or less. We have seen, post-pandemic, we have seen, in line with the reactivation of business at normal lengths and trade, we have seen an increase in premiums, more or less across all lines. But what we should, of course, not forget either, especially the hull business had many years of negative technical results. So there were some necessary corrections. Also, it was not only the increase in trade, but there were also some necessary corrections to get back to a more healthy results. And of course, there are different drivers for different businesses. Cargo, of course, the reactivation of trade, and there are positive global trade prospects. But of course, there's always a but, and even if results as of 2023 look quite nice, we have a lot of uncertainty around now. The world is getting more complex. That's one thing with ESG and decarbonization and all these geopolitical issues, which all get more all the time. And so we have more complexity, we have more uncertainty around, and also what we saw also is that there finally was some impact on inflation on claims, which we have been kind of waiting to see. And now, at least in the half figures, we have seen some impact of inflation over the past couple of years. And now we are kind of, even if Jun said that inflation is now kind of slowing down, we are now at a higher cost level than before, and also with the increasing values of vessels, and so there's of course a potential that we can get new record losses again also. So this is always lurking in the back. So we should not forget that we, after all, are there to insure some risks also, which may at some time materialize.
Let's start by looking at the whole market, which makes up around a quarter of the marine book. Premiums were up 7.6%, aggregating $9.2 billion. I want to ask those round the table who write hull business what they make of it.
Yeah, the increase was required across the whole market over the last 2 or 3 years. We went through a bit of a decile process back in 2019. The market sort of rectified itself. And obviously, as Astrid said, the claims inflation has played a big part. Cost of repairs are getting more expensive. You've got geopolitics that have a big influence as well within the market. But the premium base is probably where we need to be. There's not, I'd say, really a lot of fat in there for us to sort of give reductions at the moment. But the market's obviously, it's sort of plateaued. But I think, it's an interesting place at the minute with the premium. I think, as I say, the claims inflation is having a major part, and we're seeing the attrition has sort of still there, but the large losses have definitely increased as of late in the last 2 years.
Personally, I also think that the increase in premium is driven by the overall fleet size growth as well as the value increase. So going back to what Paul said, we have seen the premium rating level sort of improve over the last few years. We saw that kind of changes significantly slow in recent years. And that's going to be the challenge when we face sort of rising inflation. Presumably will sort of carry on for a few years rather than just stop at 2024. So I still think that the whole market face challenge going forward.
And just to add a slightly different perspective on that and not repeat, the underlying reasons for why the premium volumes are up is also very important. We mentioned inflation, the sum insured trends, but also growing vessel size. That's going to play a role in terms of how you participate in the marketplace, and then the sum insureds on specific vessels as well. Cruise vessels now are just reaching over $1 billion, and just to keep your same line size, you've got to increase the amount with which you deploy capacity on those types of vessels. So with increasing values and underlying gross tonnage going up, it's really it raises deployment of capital capacity questions. So how do you want to invest in insuring different types of vessels, and how does that play a role in your overall strategy?
Cargo insurance is the biggest marine class and was up 6.2% to hit $22.1 billion. Let me ask the cargo insurers what they think about that, starting with Rob.
Thanks. Yeah, as you say, cargo continues to be the largest part of the global marine premium, sort of roughly 60%. The numbers that Astrid and Jim presented yesterday showed a very positive picture. And if I was a glass half full kind of person, which I think I am, you would say that there's good adequacy, good performance in the business. If I was a glass half empty kind of person, I would also point to the fact that experience is only half the story, right? We're looking at a backward set of data. It's a data set that is really the outcomes of actions of the past. And there are some limitations to the data, whether it's looking at gross premiums, whether it's looking at paid losses. So I think we should be a little cautious with some of that because our jobs are to look ahead. And if I look ahead, there are some headwinds that are giving us a little bit of concern around the capacity that's coming in, but also the risk profile is ever evolving, and that doesn't necessarily manifest in the financials. And the point that Astrid sort of touched on, and this is one of our concerns, is the tail event, the severity type losses don't show in the numbers, but actually, if you look at the scale of the accumulation risk, both in transit and storage, if you look at the risk profile, particularly in the cargo book, much heavier stock throughput, the tail losses are very significant. They don't show in the numbers, but the only reason I highlight that is to not rest on our laurels. There shouldn't be a complacency in the market that the success that we've shown after a lot of hard work is fairly fragile. And I think we should just be cautious and just be mindful of not returning to some of the more challenging environments and continue with that disciplined approach.
Rich?
I couldn't agree more. The 6.2% growth in cargo, I do think, we need to dig below the numbers there a bit. Exchange rates probably have more of an impact on cargo premiums than hull premiums for one. But there is typically a correlation between economic growth in premium volume, specifically in cargo. So I think that's very encouraging for cargo insurers. You obviously want to invest more in a growing industry than the other way around. But it does vary by region and by segment. So, once again, depending upon a company's individual strategy, this could be news for further investment or not, depending upon, where you play in the market.
The maritime industry is facing a pivotal challenge: decarbonising the existing fleet. To address this, Lloyd's Register has been evaluating what this means for shipping stakeholders. Lloyd's Register's Engine Retrofit Report provides a comprehensive overview of fleet and technology readiness to transition to alternative fuels, including methanol and ammonia. This report considers the primary regulatory drivers, shipyard retrofit capacity and capability, as well as the importance of human factors and training. You can download the report at www.lr.org/ERR.
Now I want to throw it open to discuss the health of marine insurance as a whole. Are things as good as Astrid's numbers suggest?
So I think, going back to my previous comment, I think the fact that we have at the moment a very healthy, disciplined market is something that should be celebrated. And I think that's taken a huge amount of hard work. I think the products that we offer to our clients and brokers are valuable. We trade in uncertainty. That's our job. But what I would also highlight, which has been touched on not only at the conference, but Munich Re also has a trend radar that was released earlier in the year. It touches on some of the key changes that we're wrestling with, and they are of a scale that I don't remember seeing. The geopolitical piece is clearly the key concern for a number of people. This is the year of elections. This is huge ongoing conflicts. We've got huge tensions in ever-growing areas, and we're seeing a direct impact on both trade routes and trade partnerships. These are long-term sustained differences that we have to now try and adjust to. The natural catastrophe piece is a constant source of conversation, not only because of climate change, but also the secondary peril increases that we're seeing. That's something that as a market we need to come to terms with and try and understand more effectively. The point of decarbonisation, clearly something that we're all very supportive of, but creates new risk, whether it's new fuel types, whether it's new bunkering infrastructure requirements, whether it's the new EU ETS system. There's various changes that we're going through. And the last point, which I'm cautious to reference, but there are also huge uncertainties within the loss reserves that we're holding. There's a couple of events, I'm sure we'll talk about the Dali, we'll talk about other things like that just create more uncertainty in our world. So going back to my comment before, I think we're in a very healthy, good place. There are opportunities. The industry and the marketplace as a whole is positive. But there's just an air of caution. There are headwinds growing that we're watching very closely, just to say we just need to be thoughtful and mindful to how we approach the industry and take a disciplined approach looking ahead.
I think the good result in 2023 is not just reflected in the IUMI figure, but if you look at a few other sort of insurance company publishing marine results or having marine commentaries, they are sort of in a similar direction. But what that does is to attract capacity returning or existing player trying to be more ambitious to grow the market share. I'm slightly depressed that we gone through a hard market rather shortly, but returning to a soft market rather quickly. So we have to be quite careful to assess the underlying risks, to look not just the 1 year interval, but multiple year interval, to look at where this market is going and plan accordingly.
Yeah, I concur with what Rob and Jun have just said, but I think we are going into slightly new territory as well. We've got alternative fuels coming in. As you see, ships are getting bigger, values are going up. I think there's a lot we've got to learn still. Decarbonisation is a big part of what we're all looking into and how it's going to the fuels of the future. But at the moment, we've got so many vessels coming out today. I think about 550 vessels are running on LNG, and you've got another 500 vessels on order with LNG power. But that's just a bridging, as we've been pointing out at the Ocean Hull Committee meeting this morning, for the future. What fuel is going to be there, and as underwriters, it's about crew training, and it's about understanding our risks and picking our portfolio and supporting our clients going through these transition periods as well.
One thing I hear constantly is that new capacity is coming into the marine market and keeping rates soft. Some brokers even claim premiums are falling. Does the panel concur?
I think there is actually a role for new capacity, depending upon what that capacity is and how it's focused. It depends on the value proposition. If it's focused on an underserved market, if it's providing a technological solution, if it's providing a distribution solution, a geographic solution that, for whatever reason, the existing marketplace does not provide adequate opportunities, then I think it's great. I also think that having to deal with the different or new competition keeps existing and established carriers on their toes in terms of how to operate in the marketplace. With that said, if it's new capacity for the sake of new capacity because the results are good and we just want to dive into a segment that at the moment is producing a profit, then that's going to create challenges not only for carriers, but longer term for the stability of the market, which doesn't help ship owners or shippers either.
Yeah, I couldn't agree more with how Rich has just described it. I mean, there's the constant discussion around top line, bottom line focus, and different organisations have different pressure in that regard. Munich Re, we've certainly always been a bottom line profit driven organisation, and top line for us is about relevance and scale and serving those underserved markets. I think the key for us is actually, to Rich's point, it makes sure that we stay focused and provide a good service. But there's no issue with demanding and requiring a consistent, sustainable profit. But in doing so, we have to offer a valued product and a valued service that the clients and brokers may take the advantage of. So the last point I would also stress is that the way that we look at the industry is we focus on a point of adequacy. Adequacy is the absolute measure versus rate, which is relative. So whether a rate is softening or hardening, it depends on where you're coming from as to whether there's still a margin to be made there. So some good pricing, actuarial support, and a good service-orientated mindset, I think, are key as we move into the market. But there are pockets of softening across products and regions, but I wouldn't say it's at this point widespread.
I agree with my fellow panelists sort of in terms of sentiment, where we need to focus on. From my experience, clients are increasingly focused on the value, not just the price. So we need to focus on what service we deliver to the customer. So that will distract them, focus too much on the price in this sort of increasingly competitive market. So we're spending a lot time and effort on loss prevention, particularly with the emerging risks, so we can educate ourselves more and also educate our client, and with the competition coming in, so we can become more relevant and therefore handling the price competition in that way. We can't control the flood of capacity coming into the market, but what we can control is what service and value we deliver to the clients.
Astrid also compiles statistics on claims frequency and claims costs on behalf of her employer, Sefor. Her report for the first half of 2024 found that both were going up. Is that the general experience?
Well, I think so. At least that's the feedback I usually get. And they are not, they are not Nordics in the sense of the ships which are involved. No? They are Nordics in the sense that they are statistics derived from the business insured, the hull and machinery business insured by Nordic insurers, but the ships are, of course, traveling everywhere in the world. And we have, we try to be very open about what we cover and not cover. Also in the statistics, you see it in the publications. Also we cover roughly 30% of the world fleet, but if it comes, when it comes to the high value vessels, the biggest vessels, we are nearly covering like 50 up to 50% of the world fleet. So we believe the trends are quite representative, at least when you look at the large segments like container vessels, bulk or tank vessels. And and we do publish statistics regularly, at least twice a year, and we are increasingly trying to focus on specific issues which may be of interest to the industry, like fires. We have had a number of analysis which also via IUMI were used to bring this issue up on the agenda of IMODA. We have people participating, as I said yesterday in my presentation, also in the lash fire study for ro-ro vessels and the cargo safe study.
We have actually, it's certainly from our experience and probably more of a cargo focus, there has been less of a pronounced effect from claims inflation than we anticipate in some of the first party marine lines. Still an evolving factor, so I wouldn't say that's necessarily reflexive of the broader market. The severity potential is clearly the area that I've mentioned, and that's one area that gives us probably the greater concern. And the only other point I would highlight is we have seen in some areas, regional areas, an increase in theft losses, an increase in frequency of theft, which is potentially linked to the cost of living crisis, other components. But that's just one factor that, again, is a trend that we're watching closely.
I think Rich mentioned earlier that the vessels are getting bigger and the values are going up, but nobody's looking at the deductible, and that's what drives the frequency and average size going up. Deductible is a choice of clients and brokers, so as long as they pay for it, we don't have problem. But part of the driver of the losses is claims inflation tend to appear slower than the actual sort of consumer price inflation. There's also, we mentioned sort of changing trade route. The big uncertainty, particularly on the hull, in terms of the claim size, is the location of loss. So it's too early to conclude whether this changing trade route will have a big impact in the future. But we are sort of cautious whether it can change the claims picture going forward.
I agree with my panelists. We have seen a rise in claims costs. I think, the attrition has gone up. I think we've seen a slow increase in that river utilisation of vessels coming back in the oil and gas industry and in that sector. But also the large losses are getting bigger. The cost of, as I've already mentioned, labour costs, steel prices, availability of spare parts has been a bit of a challenge post-COVID. And also with the vessels getting bigger, you've got to look at where you can take these vessels for repairs now. Are the dry docks and shipyards big enough to take them? Okay, they're being built in these big yards, but they're not repair yards. So as Jun said, it's where we can then go with those vessels when they need that repair. And yeah, I agree. I think the cost of inflation has made a part on our claims costs as to date.
One final question. We've had several conference sessions on the Baltimore Bridge collapse, with lawyers telling us the US courts could take perhaps a decade to hear the litigation. But markets will react before then, of course. What should we expect?
Well, I think, first of all, we have to obviously highlight a tragic event. 6 people lost their lives. I think we should never underestimate that. As you've touched on it, there's a long way to go to determine quantum. 10 years, 7 to 10 years was mentioned yesterday in terms of defining limitation of liability, highly complex claim. I think, candidly, we haven't at this point seen a direct connection to the non-P&I marine lines of business. Where we are, again, thinking a little bit more closely is on our treaty reinsurance protections. At the composite whole account levels, there's much more alignment between the product mix. So I think there's going to be a sharing of some of the impact of how that the reinsurance community reacts to the loss. But again, it's got such a long way to go, massive uncertainty around outcomes. But clearly a major event impacting the marine industry.
And I think the Baltimore Bridge is really interesting in its potential implications to the marketplace, because from what we've seen, it's very much of a international group loss, no material damage comparatively to the hull, cargo wasn't particularly damaged. And so it's a very specific loss. But I think what it does illustrate within the industry as a whole is the importance of large loss funding for carriers, because this scenario, the specific scenario, could have been a lot worse, whether it's a lot more people on the bridge, whether it was a larger vessel, whether it was a greater loss of life. And so, the specifics of this loss, as terrible as it was, both in terms of loss of life and damage, it could have been a lot worse. And how healthy, and the industry is healthy, but in our day-to-day underwriting and in our day-to-day reserving, are we putting enough money away based upon vessel size, based upon catastrophes that have the potential, based upon this incident, to pay for these longer term?
Being the only one from a P&I club, so I'm not sure I can comment or knowing which direction we'll go. But I think from the client's point of view, this complex casualty sort of is a constant reminder of the kind of risk assessment they also need to carry out and their emergency response. So we can't sort of forecast the cost impacts of the industry, but we were increasingly focused on the loss prevention side, whether we can help the clients to prepare better, and maybe it can lead to a better outcome when a similar incident happen again.
And there you go, 4 days of IUMI squeezed into one handy-sized podcast, which I'm sure will be of interest to both those who were in the room and those who couldn't quite make it to Berlin. But if you didn't get out to the conference this year, don't worry, because next year's edition is being held in September in Singapore. That, I think, is where we'll leave it this week. Just to say that if you're not a subscriber of Lloyd's List, then if I'm honest, you really should be. Not only for Dave's continued fantastic coverage of the marine insurance sector, but also cutting-edge insight into all shipping segments, which is available anytime, anywhere. We'll put the link to subscribe in the episode description, but you can also find it fairly easily on our website. Thank you to Lloyd's Register for their continued support of the podcast. Thank you to Dave and his guests for a fascinating insight into what went down in Berlin. And of course, thank you to you for listening. We'll be back next week to look at shipping's decarbonisation journey in the wake of MEPC at the IMO. But until then, thank you so much again for listening, and we'll speak to you soon. Goodbye.